I'm Andrew McMillan, your host for the Financial Management Network. Our first segment is an interview with John J. Cullinane, who is founder of Cullinan Software, on his personal view of the American financial system. John J. Cullinane, founder of the Coalition of Information Technology Executives, is a pioneer in the computer software products industry. He was founder of Cullinan Software Incorporated. In 1982, 84, and 85, Cullinane was named as the Wall Street Transcript's CEO of the Year. He's been inducted into the Babson College Academy of Distinguished Entrepreneurs and Infomart's Information Processing Hall of Fame. Cullinane is founding chairman of the highly successful Massachusetts Computer Software Council. Most recently, he has become a member of the boards of Adapso Foundation and Century Publishing Company, Incorporated. Cullinane recently spent a year as a fellow in the Center of Business and Government, John F. Kennedy School of Government at Harvard University. Interviewing Mr. Cullinane is Michael Quinlan.
Today we'd like to welcome John Cullinane, who is the founder and former chief executive for Cullinan Software Industries. Now, John is a pioneer in the software industry and has spent the last year at the Center for Business and Government at Harvard University at the John F. Kennedy School there. He has written a paper called Widows and Orphans, trying to bridge the gap between government and business in this country. And John, I wish you could just expand a bit on the title of the paper.
Well, widows and orphans is an expression that one hears often if one entertains a public offering or doing business with the general populace. But widows stands for unsophisticated investors, the kind of person that it seems to buy the stock at the high on the day of the IPO, and from the insiders of the institutions. And orphans are customers of American publicly held companies.
This term originated apparently with the Securities and Exchange Commission beginning in the early 1930s to protect exactly those people.
That's right. It's really a quaint phrase when one thinks of Wall Street today and the 80s, that there are such things that the SEC was designed to protect, or people they were designed to protect, like widows and orphans. But it gives you an indication of maybe what the mindset was in the 30s. The basic feeling at that time was that if we could create an environment via legislation in which the owners shifted from the buyer to the seller, in other words, that the seller had to be concerned about what he sold and to whom, then perhaps we would never have a 1929 crash again, and therefore the United States would, have a strong economic future. And it really worked pretty well for 50 years or so, and as long as the United States was the economic force in the world. But now that things have changed and we are in a global economy, it's not quite so simple anymore.
So it was sort of a reverse caveat emptor in that the onus was put on the seller.
Absolutely, the seller. Because back in the 30s, when the legislation was created, the people were really furious at the banks. Right? It was the banks that they were angry with, because it was the banks that sold them the securities, not the corporations. And when those securities failed, the anger was directed at the banks, and that's why we had such legislation as the Glass-Steagall Act and others to cope with that situation, which incidentally now we're, in terms of changing of the bank legislation is underway or attempting to in the Treasury Department and so forth, the United States.
Now, apparently those small investors had some political clout.
Well, yes, I think in the 20s everybody wanted a piece of the rock, and well, in 1900 there might have been 500,000 investors. In the 1920s there were 10 million, and that represented a tremendous political force, which helped elect President Roosevelt in 1932. And one of the things he had agreed to do was to introduce legislation to cope with some of these issues. And as I say, it worked out pretty well for 50 years or so.
Yeah, the with the onus being with the seller of telling the customer exactly what he was going to do and what their brokerage firm was about, we came to quarterly reporting, apparently. What has this done to the vision of a company?
Well, I think therein lies something that all of the viewers of this program, I'm sure, are absolutely concerned with on a day-by-day basis and on a quarterly basis, and that is the performance of their respective company going to be in keeping with analysts' projections, or is there going to be some surprise at the end of this particular quarter such that a lot of people are going to be shocked and there's going to have a very negative impact on their price of their securities.
Right. So they have to constantly watch the bottom line, and that there is no major shift, or else it will affect.
Well, the
price of
greatest,
stock.
the greatest protection from a takeover today is a high share price.
Right.
Okay, so there are all kinds of implications of a drop in price that could have a negative impact on a particular company. My perspective of this is that when a company goes from a privately held status to a publicly held enterprise, the focus changes rather dramatically, even though there's great efforts undertaken to prevent that from happening. The focus shifts away from the customer and prospect to the bottom line and the earnings and the performance of the company in order to meet projections and the street's view of what the company should be doing.
So in effect, the product that the company is making might suffer, and therefore the customer will shy away, and yet the bottom line has to be protected.
Well, yes, I think that any economist or viewing the American financial system would say that any reasonable CEO ought to be able to cope with both issues, the performance issue and the customer issue. And
Right.
I'm saying is someone that built a corporation from an idea to the first software company with $1 billion valuation in America. I can say, firsthand that that's a very difficult thing to do, because one can spend 30 to 50% of one's management time, including those people that work for a CEO, concerned with the basic issues of making the numbers, okay? And
Right.
there's a great deal of, discussion about any number of issues that might affect those numbers, an acquisition, whether to do an acquisition or not, what kind of reserves are set up or not set up, and I could go down a list that's interminable, and those issues that management is concentrating on during the course of a quarter, and by definition, the focus on the customer starts to ebb and slip. In our own case, we had the highest price earnings ratio on the New York Stock Exchange for 5 years in a row, 57 to 1. A slip, would mean $500 million, worth of valuation gone just like that. So it's a highly emotional issue with a lot of pressure involved.
Is it possible to protect against something like that happening?
Well, I think that, studies show that people who, tend to take a longer view of their corporation and be upfront with all kinds of things that might happen, so can and also pay a terrific price in the marketplace in terms of their shares being battered accordingly. It's a very difficult arena to do business with. But the major point of this is not to say, gee, quarterly reporting is difficult and it takes the focus away and that sort of thing. It's that in a global economy, where you're competing with at least two nations, Japan and Germany, who have a long-term focus, have a short-term focus as well on the customer, and we have established a system in the United States. The American financial system is an absolute setup to be knocked off by the Germans and the Japanese.
Because of their concern for their customers.
Absolutely. Any organization that is in competition with, and that doesn't focus on its customers to the degree that it should, that is in competition with another organization that puts customers as number one, that company or organization that puts the customers as number one is going to win time and time again, and that's what's happening on the global scale. So the legislation that we introduced in the 30s to protect the investor, in order to protect the long-term financial organization strength of this United States, is now coming back to haunt us. The best intentions, well-intentioned legislation, which seemed to work quite well for many years, is now something that should be updated.
So this worked quite well when America stood by itself as an economic force.
Yes, when the United States was the economic force in the world, and it's certainly after the World War II, it was unquestionably the economic force in the world. And if you didn't like one manufacturer's automobile, American manufacturer's automobile, you could buy another
American manufacturer.
Right. Now, if you don't like an American manufacturer's car, you can buy a Mercedes or a Toyota or Nissan or whatever it may be,
right.
and not limited to those two countries by any stretch of the imagination. Then you've got you as a country and you as a company have serious problems.
Well, obviously, this is the bottom line, it seems, of this thinking is just common sense. To get back, although it's not that easy to change legislation, how do you propose such a simple idea get to a working
well, simple
idea.
ideas work. Common sense is extremely rare. All the geniuses I met in the computer industry, when they're speaking about something I really knew, didn't turn out to be geniuses at all. All right. So when one looks at the American financial situation, one has to come up with an idea or a method that might be able to get through the American legislative process, both in Congress and in the bureaucratic side, and that would work if implemented, and also might not have in it as a built-in number of constituencies against it, a la, the accounting profession or what have you, or the legal profession. And one of the things that I would like to see much more recognition of is the importance of the customer and prospect, attitude toward a particular company and its products or services. Why this is really so important is that a company can perform in the stock market exceedingly well 2 years past the point where it's starting to lose its reputation or, for that matter, market share. And it would be really interesting to see audited quarterly and yearly analysis of the changing market preferences for a company's products or services.
You had mentioned some vehicles to get to this information, such as surveys of customers on their buying patterns, on how they view a company, and
yes, I think that's easy. There are all kinds of studies now done of various products and services within the computer industry and outside the computer industry, such as Consumer Reports and so forth. Most companies in their respective industry use these reports or these analysis when they serve their particular purposes from a marketing point of view. But it would be quite easy from my perspective for a big 8 audit firm or a big 6 audit firm these days to develop an audit verification system that would include sending out questionnaires and surveys to customers and prospective customers of a particular company, and then tabulate those and include the results in the quarterly and annual report. And you would find that particular process alone would create tremendous interest on the part of CEO and management, of that particular company, and what the customers and prospects are really thinking about those products and services. And if there is a change, then there's a reason why that change is taking place. That products and services is disintegrating, or it's getting better if there's an upward curve. And it'd be a wonderful thing for customers and prospects of the securities of that respective company to get a sense of that while it's happening.
Do you find that there is resistance to change like that?
Well, there's always resistance to change of any kind, but I mean,
obviously it's needed. So.
It's needed. I don't think that I would have no difficulty whatsoever standing up in front of a a CEO organization and say that such a particular move was absolutely in the best interest of them and their companies, and I don't see how anybody could argue with anybody that serving customers better and knowing that your customers are having problems or somehow view your company in such a way as that they are changing their buying patterns would be a bad thing for management of a company to know in time to take corrective action. Most companies have such a bureaucratic layers rather, that if you were to go from the salesman, okay, up the chain of command to the vice president of marketing or sales through 5 levels, by the time that story gets up that level, it's changed completely, all right? And the sense of urgency there is about that particular problem gets lost in the translation.
Right. When your company went public, excuse me, you talked about the analysts that come in and almost have created, when they're talking about a company, when they're talking about a quarterly report, they've created sometimes self-fulfilling prophecies. And that it seems like an entire industry of lawyers, accountants, fund managers have sprung up just because of quarterly reporting. Now, how does this affect the widows and orphans that you talk about?
Well, I think that, you've hit the nail on the head. The legislation has created, in essence, a bureaucracy, around the particular quarterly reporting function. So there's an institutional aspect to it now.
To almost keep information from the small investors.
Well, I wouldn't say, no, there's no, you couldn't do that. No, but I mean, but
in a realistic sense.
But the lawyers have to review quarterly reports and news releases and all that sort of thing. The auditors have to review it. The analysts, people are very anxious to hear what the analysts have to say and read what they're saying relative to what the results are going to be, and so on. So a lot of people's careers are now, firmly entwined with the quarterly reporting process, right? Who don't necessarily have the best interest of a particular company at heart. So you have many CEOs and the senior financial officers who refuse to do any forecasting because they know that they're going to be subject to lawsuits. If for some reason that turns out to be wrong, there are lawyers now, what I call corporate ambulance chasers, whose goal is to find some stock that's flying high and hopefully it trips and they can engage in a class action lawsuit and use the RICO statute as part of that particular process.
Which it was not intended for.
Which was not really intended for, and 90% of now, I understand, the use of the RICO statute is in business-related activities.
And even though the company might trip on a particular quarter,
yes,
it doesn't mean that it's headed for disaster.
No, not at all, not at all. But I mean,
which is what they might try and make you believe.
Which and so in many ways there is such trepidation about forecasting and the implications of not meeting those particular results that. In an ironic way, the CEOs and chief financial officers of a lot of companies have sort of surrendered the forecasting process to analysts, to sell-side analysts on Wall Street, whose role in life primarily is to sell securities for the respective companies. And they are the ones now doing the forecasting for major American corporations, and the American corporations are sort of dancing to their particular tune. And a lot of chief financial officers feel they have to talk off a sell-side analyst off of some particular forecast if maybe it's not going to come out that way. So that whole area of insider trading becomes rather gray in this environment, to say the least.
You said you felt the pressures surrounding a company after it went public, or your particular company, were almost counterproductive to a product development environment.
Well, I think in the case of software particularly, but I think software is generally is really delivered on time, error-free, and certainly doesn't
you have to have some room in order to.
And it does not adjust itself to a quarterly cycle at all. The temptation sometimes is to meet whatever projections might become forthcoming for a particular year, is to maybe release a product prematurely and so on. And any time that's done, it always comes back to haunt not only the customers, but the company that released the product as well. That's one of the kinds of pressures that come to bear at moments in time when a company wants to meet numbers.
Mm-hmm. You talked about other problems of going public, such as a board of directors, who might not necessarily have a vested interest in the company.
Well, boards of directors, and just make a general statement, outside boards of directors are better than inside boards of directors. But boards of directors, and to quote an article in the Harvard Business Review recently by Professor William Solomon of the Harvard Business Review, is that Harvard Business School, is that no sane person should be on the board of a publicly held company. It's a very, you know, the risks are great, the rewards are few, and most you know, members of boards have other major responsibilities, their own corporations and so forth. They don't have the time to address a company's problems when the company gets into trouble. Right? And so I think there are possible solutions there that, but generally speaking, boards tend to be acquiescent, very complacent in some cases, or very cooperative with existing management, often not to the best interests of their respective company.
Mm-hmm. You said, I noticed in your article that you said that at one point you had just wanted to enjoy the 4 seasons instead of enjoying 4 more quarters.
Right.
What brought you back into the company?
Well, in 1983, I changed the name from Cullinane Corporation to Cullinet Software Inc. and felt I had done my duty, and you know, we had been enormously successful and painted myself out the corporate door. I think in the case of entrepreneurs, if you don't do that, someone eventually will do it for you.
Right.
My goal was to get away from this quarterly, you know, focus. I had done it for, you know, many years, and it's not a very satisfying, you know, career path. And I felt that I'd like to think of a year made up of 4 seasons rather than 4 quarters. Okay, and then we hit a downdraft and that sort of thing, and it just seemed that being a major stockholder that I had to get back in and try to do what I could to resolve those issues, and I think we did pretty well. And we merged with Computer Associates for $350 million a couple of years ago, so it worked out pretty well.
Yeah.
And it was, I must say, from an idea in 1968 to $350 million, and you know, it was not so bad.
Yeah. You had talked about early on in your company career of a product called Culprit.
Yes.
And the product wasn't doing very well, and your technical people wanted to sell it one way, and you wanted to sell it another way. And it seemed customer-driven wise, you created another product called the EDP Auditor.
Yes.
Just explain. I think it represents a lot about your feelings for your customers in terms of how that product went. Just explain.
Well, I think there's a lot. It's the what some refer to as the parable of the loaves and fishes, right? Mm-hmm. And we had one product that wasn't selling very well, and we were on our way out of business. In fact, we were down to a point where we had $500 left, our original $500,000 investment. You know, we had a payroll due that day of $8,500, and literally a check came in. So I thought we were not long for this world, but we had one product, and yet it lacked some features that customers wanted, but our development staff weren't anxious to do. Mm-hmm. And so in desperation, I noticed that people were looking at using our system for auditing, and I got a copy of a brochure from a Big 8 audit firm at that time, and it turned out our system actually did a lot of things that audit software, you know, should do. And so I came up with a new version called EDP Auditor, the same system with a different name, called EDP Auditor, and but it had separate support, separate training geared to non-programmers who were basically auditors background at that time, and separate support gave them independence of data processing, something they wanted, which was the integrity of the audit, and they used the product fantastically. So they would embarrass the data processing department, and so the data processing department would end up buying the Culprit version. Right? So what we couldn't sell very many of at $10,000, right, we were now selling a lot of at $20,000. So, but the key to that was that we were responsive to a specific, you know, client's or segment of the client's needs. Mm-hmm.
Well, I think to wrap up here, you had talked about one of the solutions to this problem is is making it easier for the customer, for the small investor to understand what's happening via customer satisfaction reports on annual reports, maybe monthly forecasts and yearly forecasts within 10% of sales forecasts.
Well, I think that would be another method here. There are a number of things we're going to do. One I'd like to see is the customer satisfaction levels. The second thing is that I would like to see an idea looked at seriously where that if a company submitted to the SEC their forecast on a monthly basis for the coming year, and as long as they were within plus or minus 10% of that particular forecast, they would not have to come out with a quarterly report. Okay, so they could take the focus off the quarterly report.
Also, you had mentioned pension funds, just very briefly.
Well, pension funds are on their way to owning most of corporate America.
Right.
Okay, they own 85% right now of IBM, just to give you an example. Right. And they are short-term investors too. If a company doesn't do something like, they just sell and get out, right? And I think
they need more long-term.
They're in a position, particularly pension funds, the state, city, municipal, and so on. They have a long-term interest in America. They ought to be exercising their particular equity positions in a positive way by, I think, bringing on or seeing that former CEOs or ex-CEOs represent their interests in corporate American boards. But, these CEOs would have the time and energy to address specific problems.
Such as you're doing.
Yeah, I think so. And within a particular industry and it would be a great opportunity for these people to serve. And when there's a problem, they would have the time and energy to look at that particular problem. As opposed to when a company gets into difficulty right now, most of the board, they don't want to have anything to do with it. They want to get it over. They want to sell the company, get rid of the company, and get rid of the problem.
Right.
Okay.
Well, I'm glad you've had your year to reflect back on your business career, because these ideas certainly make a lot of sense, and they should be gotten out.
Well, it was great fun to spend a year at the Kennedy School and the Center for Business and Government and think about these particular issues and why this came about. And so my experience is basically the entrepreneurs walk through the American financial system and what I found in that process. And that's in this paper, Widows and Orphans.
Right. Well, thank you very much for being with us, and hopefully your ideas will continue to get out there where they should be.
Okay, thank you.
Thank
My
you, John.
pleasure. Yeah.